would like to introduce to you our panelists for Straight Talk, Getting Traditional Loans in Today's Economy. Jill Blankenship, CEO, Frontline Call Center. Mark Costello, Supervisory Lender Relations Specialist, Seattle District, Small Business Administration. Roger Foreman, Small Business Banker Manager, Bank of America. Ruth Ann Halford, Business Development Officer, Mainstreet Bank. Walter McLaughlin, Senior Vice President, SBA Manager, Banner Bank. And your moderator, Stephen D. Strauss, Senior Small Business Columnist, USA Today.
Hi, my name is Jill Blankenship, and I'm the CEO and founder of Frontline Call Center. I started this company back in 2005 by recognizing a need to provide year-round employment for the people that live here in the San Juan Islands. I started with 5 agents. We were providing 24-hour customer support for a local barbershop that we set appointments for, as well as a local internet provider. I actually found community capital development through scored.org. I had really put everything out there, taken all the money I could from friends and family, took a second out on my home. I'm indebted to the SBA. I think on one hand, it was very exciting to have the opportunity to continue to grow, but the responsibility was really overwhelming, and again, I think it just helped me focus. We've been able to grow. I'd say our average count for agents is about 60, 65, but we go up and down depending on the projects that we're working on and certainly the different times of the year. And it's been great to, again, provide that year-round employment for the people up here in the San Juan Islands. And we also provide employment for other people in rural communities in 14 other states.
All right, very nice job. So good morning, everybody. Great to be here. Nice to see a great turnout. I'm Steve Strauss. I'm the moderator. I write for USA Today. I've written a couple books, and I'm an entrepreneur like many of you as well. And I started my first business 20 years ago, getting a loan from a friend after I got let go from my job. And boy, that was the best thing that ever happened to me. So before we get started, we have a great panel. I want to ask a couple questions. One, so who here has tried to get a loan for their business in the past? Okay, and who here has tried to get, who here has had a challenge getting the money they need for their business? Right, okay. So that's the problem, right? Getting the money we need, and that's why we're all here today. So the purpose of our panel is to help solve that problem, because who here on the panel knows how to get people the money they need? Right, so there's the solution. So what we're going to do is work together between my questions and your questions, which will be in about a half hour, and then the answers of our esteemed guests will hopefully answer the questions on how to get you the money you need. So let me just, in fact, Ruth Ann, let me ask you first. What do you think people need to know about getting a loan, a traditional loan, that they may not know?
I think they need to know, A, tell us the truth. Don't give us half the information or inflate it. Tell us exactly what you want to do with the money. Sometimes people don't do that, and you get way down the road, and it turns out that what you thought you were trying to make a loan for isn't what's actually going to happen. And be prepared to need to guarantee the loan. I have seen articles in the paper where people were complaining that they could not get loans for businesses that were profitable. And when it got right down to it, it turned out that they refused to guarantee, and they refused to put up any of their own collateral. Be prepared, you're going to need to do those things.
So are you talking about inflated numbers? Is that kind of the problem?
Not inflated numbers as much as people saying, not telling you totally what it is they want to do, or figuring they can get the loan and do whatever they want. Because there's sometimes purposes that banks, and different banks vary, that they won't make loans for.
Right.
And it's not always, what the borrower says is not always what they really mean. So.
Do anybody else want to add something to
Well,
that?
I think that's a great point, and one of the things that I would add is the relationship with the banker is incredibly important, and that trust that you build with that banker will make the difference 90% of the time on whether we do the loan or not, speaking from a Bank of America perspective. So the more connection you can have with a banker, the better the banker understands you, the more impactful that banker is going to be in telling your story to our underwriting team. And then the second piece on the personal guarantee, we pretty much don't write a small business loan or line of credit without a personal guarantee. You are the business as the small business owner, and we want you to put as much skin in the game as we're putting in. So that is going to be incredibly important to get the deal going.
So let me ask you this, Roger, just as a follow-up. So you said getting to know the person applying for the loan.
Yeah.
And I think a lot of people who apply for loans think it's just a cut and dried numbers thing. And my numbers are my numbers, and I'm going to get the loan or I'm not going to get the loan. And you're saying it's actually, there's more softness to it, right?
Yeah, if you're looking for a refinance transaction on your home mortgage, that's a numbers equation, right? That's a credit score, that's debt to income. On this kind of transaction, part of it is the numbers. We've got to have some baseline, but outside of that, it's all pretty discretionary and gray. So the more that we know you and understand your business, the better we can be your advocate to get the deal done. So it is the most gray transaction in credit we're going to get.
Steve, if I could just add, from SBA's perspective, there is a significant range of lenders here in the Seattle district market area that participate in our loan program, and to a certain extent they all have maybe slightly different niches, somewhat different risk tolerances even within the SBA program. And so what I think, even though it sometimes can be frustrating, I think is important for people to understand that they may have to get out there and really do some research as far as promoting their concept, really presenting their idea, not just to one or two lenders and then getting discouraged, but to understand that in our area there were over 90 different lenders that participated in our 7A guaranteed loan program last year. So there are a lot of different opportunities out there. Certainly the connection with that lender is important, but you also kind of need to understand what maybe the constraints that certain lenders are under might happen to be. Maybe to understand what their particular niche is can be useful as well. So,
Yeah, Ruth Ann.
One of the things that a lot of SBA lenders will do, if it's a deal that I can't do, often I know who can, and I'll send you to another SBA lender. I mean, if I can't do the deal, it doesn't mean I don't want you to get a loan anywhere. So often we will refer to one another, and something, based on something you said, I get a lot of people who come in and say, well, what's the rate on a 7A such and such? And it's not that simple. It's really not an all numbers transaction. So the fact that I can't quote you a rate, bang, doesn't mean I'm trying to evade the question. It's just not the same kind of a transaction.
And Jill, what about you? So when you started the Frontline Call Center, you went and got a loan eventually?
Well, it does take time. So it's not, and I think that's another misconception, that you can just walk into the bank and walk out with lending or funds for your company. So it really does take building relationships. It takes really having a very strong and clearly defined business plan. Because again, you're going out and you're convincing a bank that's going to have trust in you that your business is going to succeed and you're going to be able to pay back that loan. And so I did go through a 7A SBA guarantee loan process, and that took, I got, I think, $140,000 initially, and I was able to add on to that. And the whole process took about 4 months. I brought the whole team up to the island, up to my offices. I actually, at the time, Senator Ranker was not a senator yet, and I invited him, I invited my parents. It was a production. And that's almost how you have to treat it. You are, by no other terms, schmoozing the people that you, again, are going to develop this relationship with to loan you money for your business. And it really does need to be taken as seriously as is starting the business to begin with, and having that kind of dedication to what you want out of it. I think the other misconception is really knowing how much money you need. Because you can go in, I need, $250,000, when, you know what, I really need $100,000. So there's that understanding and kind of working as you build your your plan to get the funding. That's a big part of it.
So what I love about what all you said is that as much as you look at the business, you look at the entrepreneur, right? I mean, you're really betting on that entrepreneur. Because I know when venture capitalists look at putting money in a big startup, they look at the entrepreneur. They look at the team and they look at the entrepreneur. And of course, is there a secret sauce? But there's a lot more to the equation than just, how's your credit score and, how are you going to use the money? So that's interesting. You mentioned 7A lending. Do you want to talk a little bit about SBA loans and how SBA, maybe just explain how SBA loans work, whether the SBA makes the loan or how it works through the bank to make the loan?
You bet. Yeah, absolutely. I think it's important to know that an SBA loan is in fact a loan made by a participating lending institution, and it's guaranteed by the Small Business Administration. These loans can be for actually as much as $5 million, but there's no minimum loan amount. They're made, as I said, from a wide variety of different kinds of participating lenders. Here in our area, it can range anywhere from the community banks to the large national lenders. Some credit unions participate
You even
as
do
well.
like $35,000 microloans, right?
Sure, yeah, absolutely. There's no minimum loan amount under that program. And so there are a lot of different ways that the program gets delivered, sometimes trying to make it a quicker process, less paperwork oriented, but ultimately I think it's about that finding the lender that's going to be a good fit for you and making sure that they have the ability to make and administer SBA loans.
So from what I understand, SBA loans, I wouldn't say they're easier to get, but they might be, there's different requirements to get an SBA loan than a regular bank loan. I mean, why would someone want to go the route of getting an SBA guaranteed loan? So for those who don't know, an SBA loan is guaranteed by the federal government. So you go out, you go to the bank lends you the money, it's an SBA loan, and the bank is more inclined to lend you the money because the federal government guarantees the loan. So, much less risk for the bank is going to be much more likely to lend the money. So that's why they do it, right?
That's correct. I think it's more about not somebody looking for an SBA loan per se. Rather, it's a case where a business is probably going to be put into an SBA loan because of their particular situation is going to dictate that that's going to get them the best terms and conditions on the loan for their business. So, for example, businesses need typically anyway, as long of a time frame to pay their loan back as they can possibly get. And I think that runs counter a little bit to what lenders typically are trying to do, which is to get paid back as quickly as possible. The SBA guarantee gives kind of the lender and the borrower to have an opportunity to have the best of both worlds. 85% guarantee, let's say, on a loan makes the lender feel a lot more comfortable with providing a 10-year term on an equipment loan than what they would typically offer.
So then what does the SBA look for when it decides what loans it would guarantee and what loans it would not guarantee?
I think that you hit on it here a second ago, Steve, in that we're providing the lenders an opportunity to kind of expand their horizons a little bit in terms of their risk. So, for example, ultimately, we want to know that the bank has looked at the deal and concluded that the borrower can reasonably repay the debt. But things like fully collateralized loans aren't necessarily going to be a requirement with SBA. Things like 3 years of stable historical profitability aren't necessarily going to be a requirement with SBA if we've got a business that has turned around over the last couple of years, is now profitable. Things like certain ratios as far as their capital and debt to net worth aren't necessarily going to be as hard and fast as they would be in what you would consider to be a conventional loan. So somebody could conceivably go in and buy a business with maybe 15% down, or could conceivably go out and finance a piece of real estate with 10 or 5% down if it was an already existing business with a proven track record.
So what are some of the other, maybe Roger and Ruth Ann, you can answer this, what are some of the other ways that people could reduce, to show the bank that the risk is less, how to put themselves in a position to reduce the risk for the bank and therefore, get a loan? Is it a personal guarantee? Is it collateral? What would it be?
Yeah, either one of those two, Steve, are key. The guarantee is incredibly important to us, as we talked about earlier, because it's sort of that mental game piece. Collateral is another big piece. If we have an asset that's going to help us feel better, at the end of the day, though, cash flow is the most important part, the most important numeric part of that transaction. So we want to make sure the business has the ability to repay that debt. That's the first thing that we're looking at. Yeah.
And collateral is something that is often misunderstood. Well, as Mark says, sometimes you can get an SBA loan that isn't fully collateralized, but I was talking to a prospective client recently, and I said, okay, we're typically looking at an 80% collateral ratio. So he took that, instead of that being the loan is going to be 80% of the amount of the collateral, he thought it was the other way around, which was probably my fault because I didn't explain it well enough. So yes, you can get one when it's under collateralized, but that doesn't mean if you've got available collateral, you can just refuse to put it up, because that's not going to make us very happy. And as Roger said, we want you to have some skin in the game. If your position is, well, I'm not risking my whatever, my house, so then why should we? So that becomes an issue.
So is it possible to get a bank loan for a business without collateral?
I'll say, depending upon the size, yes.
Maybe.
Okay. We do them quite frequently, but assuming the cash flow is strong enough, the answer is yes.
Okay.
And it's certainly possible to get one without enough collateral, in the sense of the collateral doesn't have to be as much as a loan. And we also look at other secondary sources of repayment as well. So if somebody else in the family has a job that is bringing in income, that's good. A secondary source is a secondary source. It can be collateral, which if we need to, we have to liquidate to get any cash out of it, which nobody really wants to do, in spite of how vicious you might think bankers are. But other secondary sources work too. If you've got a day job and you've got income coming in, that can work. So
Jill, you were a startup,
Right.
right? So how did that process work for you?
I owned my own home, and I definitely had to put that up for collateral, and that it was a motivator. Like, failure is not an option, because me and my kids are going to be on the street if this does. But that was a big help, because I went in for financing pretty quickly after I started the business. I didn't have a whole history. I certainly didn't have 3 years. So I had to convince the team that not only could they count on me, but that the company was going to succeed. And so there were a lot of other factors other than just having a home that had equity at the time, thank God, which is a little bit more challenging today with the values that, gone down a bit. But that was, I would say, the key for me is that I owned my home.
And you had equity in the home.
And I had equity in the home.
So is that true for all startups? Because startups traditionally, from what I understand, tend to have a harder time getting a loan than a regular business. If a business has been around for 5 years, they have a track record. The bank can look at the track record. It can see how much money it makes every year. Look at the books. But that's not true with a startup, right? So it's easier for a bank to give a loan to an established business than to a new business. So how can a new business, especially maybe even a micro business, approach a bank and look for a loan? Are there certain programs that they should be looking at maybe?
Oftentimes, I'll speak for Bank of America, when we have somebody that comes to us that has less than 2 years of industry or history running the company, we look first at the cash flow models, making sure that we can help them be as efficient as possible with cash flow. Because oftentimes what they think they need is not the reality.
Yes.
So we can help improve receivables, for example, speed up that cash flow cycle and solve the problem. Our goal is to try to make the business as healthy as possible without access to credit in those first couple of years. So at year 2 and 3 and 4, as they're really starting to grow, we've got some track record and we're able to make a better decision.
And just to piggyback on what he said, I have had clients, and I'm sure you have too, who come in and they need, or they feel they need cash because all of their cash is tied up in their accounts receivable. And when you look at it, a lot of those receivables are 60 and 90 days. And people don't like to call their customers and tell them to pay. But you know what? It's cheaper than getting credit often. So yeah, sometimes just poking at them a bit works.
Yeah.
Sorry.
No, I think another thing to add is really just plan your funding and getting extra money when you don't necessarily need the money. You know, a lot of people, you kind of get yourself into a corner where then you're desperate. I think really the pre-planning and even going through the process of getting money, especially when you don't need it, is huge. And then you can kind of socket it away or do something with it. But I think that's another.
Or even maybe just a line of credit, right? So it's available to you when you need it,
Yeah.
and then you use it when you need it, and then you pay it back.
Yeah.
And I know the SBA has certain programs for new businesses, right?
Yeah, I was going to say, Steve, that if we're always kind of looking at the numbers and trying to figure out who's getting SBA financing, and over the years, certainly, I think in the last several years, fewer early stage businesses are getting SBA loans, but the fact of the matter is I think it's still, if we're talking like 0 to 2 years, you know, true startups up to 2 years, kind of like what Roger alluded to, probably 20% of all of the SBA loans that are made are going to those kinds of businesses.
So that's
and
fantastic.
So
right?
that kind of tells us, number one, that we've got a pretty well-educated field of lenders out there who understand how the SBA program can be used. And it also tells us, I think, that there are a lot of those businesses out there that are presenting really sound proposals, and they're selling themselves. And not only are they able to present data as to how the loan is going to be able to be repaid, they're also able to talk about it. And they're able to come up with what would be considered to be a reasonable amount of their own funds into the deal. And they probably are going to have good credit history. And in that situation, that would be enough for an SBA lender to do the deal according to where SBA is coming from. So if you can convince the lender that your deal has merit at that point, regardless really of whether you got a house to pledge or an abundance of collateral, theoretically that SBA loan is possible in those situations. And I think that is happening, so.
What people will look, what Jill said about planning, people will look carefully at what your plan is. And she's talking about the timing. If there's seasonality to your business and you're doing a month-to-month cash flow, we would expect to see that seasonality reflected, and we would expect to see when you're going to fall into a cash flow pit. You know, suddenly all the money's going out and nothing's coming in. If you're looking at that and understanding that the seasonality of your business will make that happen, it plays a lot better than if you've just taken whatever you think your sales are and every expense you have, divided them all by 12 and put it in month by month. Because most businesses don't work like that, and you're going to have a hard time convincing me that yours does in most cases.
So that's a good segue into my next question, which is let's talk a little bit about business credit. Because often when someone starts a business, for good reason, most people who start a business start it with their own personal credit. But if they really want to get a loan at some point of any value, they're going to need to have established business credit, right? And so, any or all of you, how does one do that? How important is it to have separate business credit from your personal credit? What do you think of commingling? None of us have done that, right? Who wants to take that?
The commingling question comes up all the time, and everybody seems to do it, and I'm sure all of us have spent some time telling people not to, and everybody who's in the audience who has a business has probably done it. It makes life a little simpler if you can separate the two. However, it doesn't mean we're not going to look at your personal credit. I mean, we're still going to look at it even if you've got 3 years of financial statements for the company. So even though you've got a corporation, we're still going to look at your personal credit. Yes, your business credit gets built up, but we're still going to look at your personal credit.
Excuse me. To Ruth Ann's point, the credibility of the individual owner is very, very important. So that individual FICO score is one of the first things that we pull and look at. And that's one of the first obstacles we've got to fight through if for some reason that comes in low. So business credit is certainly a big piece of that, but that personal FICO is an even bigger obstacle.
And for the credit, I found in my industry, it really helps when I'm bidding on government contracts, certainly even private contracts that have substantial revenue and cash flow that's going to be throughout the project. So business credit, and we actually bid on the health benefits exchange for the state of Washington, and it was a requirement as part of the proposals. We had to get our GMB and, you know, get that all at a certain score level, and we had to work, you know, it took about 30 days to get all the documents into DMB so that we could get an actual score with them, but that was a requirement as far as the contract went.
Let me add something to that too. So I am a attorney, although I'm a recovering lawyer. I don't practice anymore. But when I did practice law, money was the area of law that I practiced, right? Startups and bankruptcies and that kind of thing. And commingling is really dangerous from a legal perspective, because one of the reasons you incorporate, a main reason you incorporate, is you create something called the corporate shield, so that your business life and your business credit and your business finances and liabilities are separate from your personal ones. So if something goes wrong with the business, the corporate shield protects you personally. So then all of a sudden your house isn't at risk, your investments aren't at risk, you know, all of those things, if you have a legitimate corporation. But if you commingle your funds between your home, your life, and your business, that's an easy way to get the corporate shield to be evaporated legally. So a main reason for not commingling among, besides that as good business practice, is it's smart personal practice if you want to protect your assets. And I just want to add one more thing about how to establish business credit. So you need to get, as mentioned here, a DUNS number. You need to probably get an employee identification number from the US government. And then you start to establish credit like you would establish your personal credit. You'd go out using those numbers and you get a trade credit account. And you make sure that that trade credit account reports it so that you begin to establish credit. It's kind of like your own personal credit. You get your numbers, you get some credit, you pay it off on time, you pay it off in full, and then you slowly begin to build up your business credit profile, which would be separate from your personal credit profile.
And you can work
Is that
with your
accurate?
vendors and get, you know, anyone that you pay money out to, you can get them, and there are actually forms that, you know, shows how much you pay them, and then you submit those forms. So it's other than personal, you're really dealing with other businesses that are going to give you that, those references.
So we only have a couple minutes here before I'm going to take questions from the audience. So what I'd like to do is ask each, and we're going to start at the far end, Mark, each member to tell the audience what you think the most important thing that they need to know in order to get a loan, a traditional business loan. What do they need to know? Okay. What would make a difference?
I think it's really important, as I kind of mentioned earlier, to understand that there are a lot of different points of access to financing, ranging from commercial lenders to credit unions to some savings and loans to large lenders, and that they all have ability, but that you need to do your research to determine which one's going to be the right fit for you. Along the same lines, or kind of in keeping with that theme of understanding what's out there, I would be remiss if I didn't point out that through the Small Business Administration and a couple of our key resource partners, there are some great opportunities for people to get assistance in developing a financing proposal and developing that compelling business plan. Specifically, I'm talking about an organization called SCORE and another one called the Small Business Development Center. Both of these organizations offer no-cost confidential counseling to both startup and existing businesses. And I just think it's important for people to understand sort of the landscape, not only of lenders, but also of support services that are available to would-be and existing business owners.
Very good. Ruth Ann?
I want to reiterate what Roger said, that what we really need to know is that we're going to get paid back and how, and if plan A doesn't work, then what? The SBA guarantee is part of the then what, but there's also collateral, there are also additional secondary sources. And that plays into the whole thing of how can I sell this to my credit committee? So what can you tell me in that range that's going to give me some selling points for your credit?
Yeah, well said. I would say two things. Relationship is number one, somebody you can connect with. There are a lot of bankers out there, so you got to pick one that you're comfortable with. And then the second piece is flexibility. We may come back at the end of the conversation and say, we're not comfortable with X, but we are with Y, and here's why we're comfortable with this. So be flexible to listen to an alternative, because primarily the deals we lose are because for whatever reason the customer and us are not seeing eye to eye on the right solution.
Good, Jill.
Yep, and take the time to plan and have a really good proposal that you can make multiple copies and work with, again, there's a lot of options that are available for you. Just be prepared for it and have your information that's correct, and know that, have that almost like your company Bible, that you've got your financials, you've got the business plan, you've got the projections, and go in prepared so that...
So you know your numbers cold.
Know your
know your
numbers.
business cold, right?
Absolutely.
Do not go in and when you have a question say, gee, my accountant did it, you'll have to ask them. Do not do that. know what
your
the thing
business.
says.
So I hope everyone gets that these people want to lend you money. So just make it easy for them to do so to the extent you can, all right? Please join me in thanking our great panel for their